The next type of adjusting journal entries are accruals. I will introduce accrued liabilities and accrued receivables. In some textbook, accrued receivables also called accrued revenues. Accruals involve cash flows that occurred after the expense or revenue recognition. It is different from prepayment. For the prepayments, cash flows, either cash inflow or outflows, are before expense and revenue recognition. And for prepayments, the adjusting journal entry follows the regular journal entry. While accruals, the adjusting journal entries are before the regular journal entry. Let me introduce accrued liability first, or accrued expense. So this journal entry, we will debit expense and credit liability. The typical journal entry is we debit expense, liability usually is a payable. So that indicates the company incurred expense, but the payments will be in the next accounting period. There is no cash outflow currently. Instead, we record a liability, a payable. Here is an example of accrued liability or accrued expense. So during July, the company paid $5,000 for the salary for the first half month. Remember, we have recorded this transaction already. Here, this one, we record the first paycheck, $5,000 during July. This $5,000 is for the first half month salary to the employees. By the end of July, on July 31st, assume that salary for the second half of July are $5,500, and the payment will be made in next month, August, or next accounting cycle. The second half salary expense was incurred in July. So by the end of July, on July 31st, we should recognize this expense because these labors are consumed or used in July. This is an accrued liability or accrued expense. We debit expense, salary expense, while credit salary payable. Similar to this, the amount is $5,500. The impact of this transaction on the accounting equation or the balance sheet is a liability increase $5,500. A stockholders' equity decrease $5,500. So the accounting equation is still balanced. Stockholders' equity decreased because an additional $5,500 expense was recognized. Liability increased because salary payable is recognized. After this adjustment, the total salary expense incurred during this month will be $10,500, which represents the total salary expense incurred in July. So there was no payment, but the payment will be in the next month. So we record it as a liability. It is easily understandable that the company indeed incurred 2 half months salary expense. One is $5,000 for the first half, $5,500 for the other half. Total $10,500. If we do not make this journal entry, the salary expense will only be half month, the first half month, $5,000. The salary expense will be understated. So we should make this adjustment to recognize $5,500. But this is a internal transaction. It is not as obvious or evident as the external transaction. In August, the company paid their employee for the second half salary in July. The company will debit salary payable and then cash $5,500. So the salary payable will reduce $5,500. and the cash is paid. Assets decrease. The next example of accrued liability is interest payable. This is accrued interest expense. Because the company borrowed $40,000 from the bank as notes payable. This $40,000 was a result from this transaction. By the end of July, 1 month has passed. We should recognize 1 month's interest expense. Because interest expense is a function of time. 1 month passed, the company should incur 1 month's interest expense. So interest expense is calculated using the principal multiply interest rate. In accounting and finance, if you are given an interest rate, it is annual interest rate. The principal multiply annual interest rate, that is annual interest. Well, we need 1 month interest expense, so we time 1/12 or divided by 12. So we get 333 rounded. So we should recognize $333 interest expense for this company. Even this interest will be paid when this loan is due. By the end of July 31st, again, according to this adjusting journal entry, we debit interest expense and credit interest payable. 333. And the payable will be written off when the interest is paid. The reason we recognize interest expense, the company use the fund, and the cost of fund is interest. So the company should recognize 1 month interest expense, even no payments has been made. Let's try this multiple choice questions. The grocery borrow 12,000, interest rate 8%, which is annual interest rate, on May 1st, 2024. And the loan is due next year. It's a 1-year note. The company's fiscal year ends on December 31st. That indicates the accounting cycle ends on December 31st. So from May 1st to December 31st, that is 8 months. Correct? So from May 1st, the first day, to December 31st, 8 months. So we should recognize the accrued liability or accrued interest expense on December 31st. The last day of the accounting cycle. So first we should calculate the interest. So we just use 12, the principal multiply annual interest rate and multiply 8/12. So interest expense to be recognized was $640, which represents 8 months interest expense. And the journal entry will debit interest expense and credit interest payable. The interest will be payable on April 30th, 2025, next year. You know the company is going to pay the principal plus all the interest on April 30th, 2025.